Hello everyone and welcome to this new video where I will share with you what I learned regarding the Black-Scholes model, why it fails, regarding the constant volatility assumption, flat surface against the real smile. So, Black-Scholes model is elegant, Nobel Prize winning, and is still used every single day on every options desk in the world. But it rests on an assumption that markets have been quietly rejecting for decades. It's the assumption that there is constant volatility. So by the end of this presentation, you will understand exactly what that means, what the data actually shows, and why the gap between the two matters. So before we talk what about goes wrong, let's be precise about what the Black-Scholes actually assumes. The model has five core concepts or inputs: log normal returns, constant risk-free rate, European style uh, exercises, frictionless market, and crucially, the constant volatility sigma. This sigma appears right here in the formula. It's the only input you can't observe directly. You have to estimate it or back it out from the market prices. And the model says pick one number. That number applies to every strike, maturity, every options on the same underlying. One sigma to rule them all. That is the assumption we're going to challenge in this presentation. So, what does constant volatility actually predict? It predicts that if you take any two options on the same stock, let's say a deep out of the money put and at the money call, and you back out the implied volatility from each one using the Black-Scholes formula, you should get the same number every time for every strike, for every expiry. Geometrically, this means that the implied volatility surface, like when we put the strike on one axis and the maturity on the other, the implied volatility uh, should be completely flat, like a boring horizontal line. That's what you see on the left. Every every cell reads 20%. That's the word Black-Scholes lives in. Now let's look at the reality. This is the boring Black-Scholes prediction of flat or constant volatility. So for the volatility smile, this is what market actually shows. Look at the chart on the right. The gold line is the market implied volatility plotted against the moneyness. That's the ratio of the strike to the spot price. The gray dashed line is the Black-Scholes prediction, flat at 20%. So we can see that the gold line is not flat. So as we move to the left, into the out of the money put territory, so this side, the implied volatility rises sharply. This is the volatility smile, or more precisely in equity markets, the volatility skew or smirk, because it's asymmetric. The out of the money puts are expensive, they price in fear, and the Black-Scholes with its single sigma cannot produce this shape. It's not a small discrepancy. We're talking about implied volatility that can be 10 or 15 percentage points higher for deep out of the money puts than it is for the at the money options. That's a big difference, and it didn't exist before October 1987. The crash created it and it never went away. So now let's extend this to the full picture. On the left is the word of Black-Scholes. Every cell in that grid reads 20%. It doesn't matter if you're looking at the 1 month option, 12 month, 80% moneyness, or it's at the money, same number everywhere. And on the right, the real implied volatility surface for an index, let's say for the S&P. Look at the top left, 1 month, 80% moneyness, that's 38% implied volatility. If we compare that to the 20% for the same underlying, same model, we have wildly different numbers. The surface has a shape. It slopes down from the out of the money puts. It has the term structure running left to right, and it forms what we said again in the previous slide, the skew. So now we know that the Black-Scholes predicts none of this. It produces a flat plane or constant term. So every deviation or a number that deviates from the 20% is information that the Black-Scholes simply throws away. So why does the smile exist? It's what the market actually pricing that. So let's repeat. Why does the smile exist, or what is the market actually pricing that the Black-Scholes model is missing? So 4 things. First of all, the fat tails. Equity returns are not normally distributed the way Black-Scholes assumes. They have excess cortices, so extreme moves happen far more often than the model predicts. Second, the jump risk. Prices don't just diffuse smoothly, they gap overnight on earnings, on macro events, etc. And the diffusion model by construction cannot price a jump. Third is the leverage effect. When stock prices fall, volatility tends to rise. So there's a negative correlation between returns and volatility that the Black-Scholes ignores entirely. And this is what creates the asymmetry, the skew rather than a symmetric smile. Fourth, the pure supply and demand. Institutional investors buy out of the money puts to hedge their portfolios. That demand pushes up the price of those options, which shows up as elevated implied volatility. So none of these four phenomena are or can fit inside the Black-Scholes framework. So we can see it's not just a theoretical problem. If we look at the table from the bottom, for an at the money option, Black-Scholes does fine. The error is essentially 0. But as we move out of the money, the model starts to break down badly at 94%. At 94% moneyness, it underprices by 32%. At 87% moneyness, deep out of the money put, it underprices by 82%. So if you sold that option using the Black-Scholes and your pricing model that and the market moved against you, you are dramatically under reserved. This is not hypothetical. This is exactly what happens to portfolio insurers in 1987. The model said those tail risks were cheap, but in fact the market eventually proved that they weren't. And at the top of the slide, as you can see, delta hedging, the cornerstone of the Black-Scholes risk management, also breaks down because delta is computed assuming that the volatility is constant. So the moment volatility moves with the market, your hedge ratio is simply wrong. So where does this leaves us? So in the real world, Black-Scholes is still everywhere. Every options desk quotes in implied volatility using the Black-Scholes formula as the translation layer. It's the market's common knowledge, but, and this is the key insight, traders don't use it because they believe it. They use it as a quoting convention, knowing fully well that the model is wrong. The smile is the Black-Scholes' own confession. If the model were true, implied volatility would be flat. It isn't. So the entire volatility surface exists precisely because markets know constant volatility is a fiction. The research response to this has been a generation of better models like the Heston model, which makes volatility stochastic, and the other models like widely used for rates, local volatility models, and more recently the rough volatility. All of them are attempts to fix the single flaw we talked about today. So one wrong assumption, which is the constant sigma, that's what breaks the Black-Scholes model. So that's it for this video. If you reached this far, please like and subscribe.